The average American reaches retirement age with less than $90,000 saved. That's not because they didn't try. It's because small, invisible mistakes compounded over decades into something they couldn't recover from. And the frustrating part is that most of these mistakes are completely avoidable once you know what to look for. Let's start with the most expensive one: not capturing your full employer match. A lot of people contribute to their 401k, but they stop short of the percentage their employer will match. If your employer matches 100% up to 4% of your salary, and you're only contributing 3%, you're leaving free money on the table every single paycheck. Vanguard's annual How America Saves report consistently shows that around 25% of participants who are eligible for a match don't contribute enough to get all of it. On a $60,000 salary, missing a 1% match every year for 30 years, assuming historical stock market returns near 7% annually after inflation, a figure derived from long-run U.S. equity data tracked by researchers like Jeremy Siegel, could mean giving up well over $50,000 in retirement wealth. The employer match is the highest guaranteed return available to most investors. It has to come first. The second mistake is holding too much cash inside your retirement account. People open a Roth IRA, feel good about it, and then leave the contributions sitting in the default money market fund, sometimes for years. The account existing doesn't mean your money is invested. You have to actually purchase funds inside the account. This is one of the most common and least talked about errors. Third, ignoring fees. A 1% annual fee difference might sound small, but research from FINRA and Vanguard both illustrate how a 0.5% expense ratio versus a 1.5% expense ratio on the same portfolio can reduce your ending balance by 20% or more over 30 years. Low-cost index funds from providers like Vanguard, Fidelity, or Schwab often carry expense ratios under 0.10%. That difference accumulates into real money. Fourth is cashing out when you change jobs. According to Fidelity's retirement research, a significant portion of people cash out their 401k balance when they leave an employer rather than rolling it into an IRA or their new employer's plan. When you cash out early, you pay income tax on the full amount plus a 10% early withdrawal penalty. A $15,000 balance could shrink to $9,000 or less after taxes and penalties, and you permanently lose all the future growth that money would have generated. And fifth, treating retirement accounts like they're all the same. A traditional 401k gives you a tax break today, but you'll pay taxes on withdrawals in retirement. A Roth account flips that. You contribute after-tax dollars now, but qualified withdrawals in retirement are completely tax-free. Which one is better depends on whether you expect your tax rate to be higher now or in retirement. For most people early in their careers, the Roth tends to win. For higher earners in peak earning years, the traditional often makes more sense. The point is that this decision has a real dollar impact, and it's worth spending 30 minutes thinking it through. So here's the first step worth taking this week. Log into your workplace retirement account, or open one if you haven't, and check two things: whether you're contributing at least enough to capture the full employer match, and whether your contributions are actually invested in a fund rather than sitting in cash. Those two checks alone put you ahead of a significant portion of retirement savers. The rest can follow from there.